Y ya tengo conectado a Jay Pelosky, fundador en TPW Advisory. Jay, good afternoon. Good morning for you.
Thanks, Martha. Good afternoon to you.
These midterms show there is no red wave, but still the Republicans are winning in the House of Representatives. What could this mean for policies Joe Biden wants to put in place? We can say that Biden is dodging the worst scenario for his term.
Yes, I think clearly that's the case, right? When you look back at recent history, whether you go back to the 90s with Bill Clinton or the 2010s with President Obama, the Republicans picked up 50 to 60 seats in those midterm elections. That's clearly not going to happen here. I think there were some poor candidates chosen by the Republicans to run, and that hurt their chances. And there was some strong support along the issues of abortion and others that generated support for the Democrats. And so we have probably, even if the Republicans take the House, which they may do, they're only going to have a very small majority. They're going to be split internally, and I don't expect a whole lot to come from that policy-wise. And so I think, for the most part, for the next 2 years, the U.S. is not going to have anywhere near the big political policy measures that we've seen from the first 2 years of the Biden administration.
Meanwhile, Ron DeSantis is seen now as the midterms winner, with no doubt. What do you see that? He won in Florida, and all eyes are on him, remaining the presidential election in 2024. How do you see the figure of Ron DeSantis?
Yeah, no, I think you've got it exactly right, Martha. He's the clear winner. Not only did he win his race in Florida, but a lot of former President Trump's candidates who he supported did not win. And therefore, it's clearly setting up to be kind of an internal fight within the Republican Party between Ron DeSantis and former President Trump. And so that's going to be clearly very interesting to watch and to observe. And I think that's going to be the main issue, and could start as soon as this week. Supposedly, former President Trump was going to announce his intention to run again off the back of what he hoped would be a red wave where he could take credit for that. That's not going to be the case. So it's going to be interesting right from the start. We're going to be talking now for the next year and a half about the Republican Party and who's going to run and who's going to represent it. And, that's going to be an interesting political debate. I don't think it's going to necessarily have much impact on markets, though.
Really interesting. You said about the big announcement that Donald Trump will make next week, 15th of November. Do you expect him to run really in the 2024 elections? Because we know very well that Donald Trump doesn't like to lose, and it's not all clear that he had popular support.
Yes, no, that's very true. The way you described it, Mark, and so I expect him to try and run. I mean, he is under investigation in multiple states for multiple issues. He may well be facing trial at some point over the next 6 to 12 months, which may make it a moot point. And damage his support sufficiently such that Ron DeSantis kind of becomes the nominee almost by default. I mean, that's all to come. I think, at TPW Advisory, as you know, we're focused on markets. And for us, the political action and even the policy action in the United States in particular, we do not think is going to be as dramatic as it has been over the last several years. We're looking for more of stability in 2023 as COVID fades, as inflation fades, as the Fed tightening cycle fades. All of that we think is going to lead to some more stability in 2023 at least, and that hopefully leads to a better outcome in the out year, 24, 25, 26. So that's our focus. It's not really politically motivated. It's not even policy motivated. We think the Fed is closer to being done than starting. We don't expect much in the way of fiscal policy in the U.S., and we didn't before the midterms. The midterms really don't have anything to do with that. We've done the bulk of the fiscal spending. Now we're tightening fiscal policy in the United States, unlike in Europe and in Asia, where fiscal policy continues to be supportive of growth. So that's really our focus. We're looking for kind of a more calm year after several very volatile years. And we think that's going to be good for financial markets, whether or not President Trump runs, whether or not Republicans take control of the House. I think those issues are going to be less important to markets anyway than they have been in the last couple of years.
Precisely, Jay, I want to ask you about markets. How will the stock market react these days when we collect more information about the results of these elections? Do you think this is the best outcome for the stock market? And we can't forget the state of Georgia is key, and could be another round, the 6th of December.
Yes, no, I think that seems like it's going to be the case. So we may not know the outcome of the Senate until, for another month or so. I think really, look, the markets are focused on the inflation number that's coming tomorrow, I believe, focused on the Fed, what the Fed is likely to do in December, and really trying to game out where the Fed ends its tightening cycle and what that means for the dollar in particular. As you know, we've discussed many times, we're very focused on the dollar. We think if the dollar weakens, as we expect, that sets up opportunities outside the U.S. for non-U.S. equity and also for commodities, which do well when the dollar weakens, because many of the commodities, as you know, are priced in dollars. So weaker dollar means better demand for commodities. And that's kind of the way we've positioned our model portfolios. We're overweight the non-U.S. markets. They're very cheap relative to history, very cheap. Europe, for example, is the cheapest it's been versus the United States in the last 30 plus years. China equities are extremely cheap. Brazil, extremely cheap. So there's opportunities which we think the market is looking at and thinking about. And once we get confirmation that inflation is rolling over, that the Fed, we're likely have to price in the Fed terminal rate around 5%. That's already in the price. That starts to lead interest rates to stabilize. And as interest rate volatility goes down, and it's already come down dramatically just in the last couple of weeks, if you look at the MOVE indicator, peaked at 160, at 125 today as an example. Volatility comes down, dollar rolls over, non-U.S. equity gets a bid, and that's the focus, I think, for 2023.
Finally, Jay, do you believe we will have a Christmas rally this year?
I think there's opportunities for the market to continue to do well. I mean, sentiment is still lousy, right? Positioning is still very much offsides. Cash levels are still extremely high. But I think we need confirmation that inflation is clearly rolling over. And we just really haven't gotten that clear, definitive sign that inflation is rolling over. And once we get that, then since we've already priced in the terminal rate of over 5% in the fixed income market and therefore in the equity market, once we get that clear sign from inflation, then, as I said, interest rate volatility declines. And that's really what's been driving stocks. When interest rates come in, go lower, stocks go higher. And particularly the tech stocks, which have been a big drag on the S&P this year. And that's one of the reasons why it's very interesting to think about non-U.S. markets. They don't have as big a growth or tech weight as the U.S. does. So higher interest rates don't hurt them as much. And you can see that in Europe, right? Europe is outperforming the U.S. over the last month or two for precisely that reason. And so it really, Marta, I think it's all tied up into inflation, interest rates, volatility, and then kind of people starting to position for 2023. We're constructive at TPW Advisory. We think there's room for a rally, but right now we're in that in between, where we bounced off the lows of June 3,600 several times, but we can't seem to get above 4,000. And that's why I say we need some sort of real strong catalyst. And that catalyst is probably going to be one of two things, and they probably come together. One, inflation goes lower. Two, the Fed validates the idea that Chair Powell opened up, which is that we're going to go a little bit slower in our rate tightening cycle. Once we get that clear confirmation, those two things come together, volatility collapses in the fixed income market, stocks go higher.
Because tomorrow we will know the new inflation data. Jay Pelosky, thank you so much. A pleasure.
Thank you, Martha. Always.